All right. Thank you, everybody, for inviting me again. Always enjoy it. So let's get going, guys. We only got a short 40 minutes here, and I'm intent to teach you something of value that you can use tomorrow, if not this afternoon. So a little bit about myself, but you can go read more at the brokerage firm, mastertrader.com. Started out in the late 80s, just like probably most of you. Well, maybe not most of you, probably most of you knew more than I did in the late 80s, but started out by then knowing nothing in late 1994. Started a service, fax service. Remember thermal papers and hotlines, chat rooms, when chat rooms were no chat rooms. Um, Eventually evolved. Master Trader used to be a brokerage firm, if you're not aware, one of the first ever out there for retail traders. And I had many recordings, sold them all off in 2015. Used to do trading challenges, educated a tremendous amount of people over the years and continued to do that. Started out with specialists and hedge fund managers, eventually prop traders, retailers, and people like yourselves. As things evolved and the internet grew. And if you check out my website, you can see names of companies that you're probably familiar with today that are my students. Testament to the education and the longevity of it over all these years. So this was me, the guy in the middle. Much more hair on his head, slimmer, and suited up there in the expos in 1999, Traders Expo, first one ever. That was our booth, and our theme of what we taught was called T3 trading, 3T method of training, trading, and technology. And that was the big booth, and it was called a pristine day trader at the time. And eventually, Master Trader, as I said, became a brokerage firm. So, Master Trader Technical Strategies, that's what we teach. What is that about? Well, these are all of the segments of what I call thought building lessons. Um, Price is king. That's what we trade. No matter how you approach a chart, if you're looking at a chart, you're looking at prices. Candlestick format, bar by bar analysis is a concept that I developed years ago. What do I do when I'm in a trade? I mean, once you get in that trade, you become a victim of your own mind. And so we need something to be able to stay in the moment. And bar by bar analysis is my way of saying, hey, what does that bar mean? Whatever you're going to call it. I'll call one a topping tail bar, right? And it's like, well, yeah, it got rejected in the moment, but is it in an uptrend? Is it at resistance? So the addition of, as this says, trend analysis, multiple time frames, support, resistance, relative strength and weakness, volume. What are the broader markets doing? All of these things come together to guide us. And as it guides us, we know one of these concepts is not a strategy. And this is what MTS is built on, is taking all of these concepts, and these concepts have subsections underneath them, meaning, candlestick analysis, there's different kinds of candlesticks. Well, different names to them, different forms, trends, up, down, and sideways. How do we determine what the trend is? Well, it's not with indicators and it's not with trend lines, and it's very simple, right, which I'll explain to you. The combination of multiple time frames, putting that together, a tremendous thing to put the odds in your favor. So all of these concepts, their focus is to give us the greatest probability of being on the right side of a trade. And of course, then it comes down to, how do I manage that position and manage the money, which is the most important part of your trading plan, because without that, you will not last. And trader psychology, maybe you do need a therapist, maybe you don't. But without position and money management, you will need a therapist because you will lose all of your money. So trader psychology is directly related to the position and money management part. It's essential. Without that, no one lasts. So how do we approach this? Meaning, how from a trader's mindset. And we got to put it in perspective, this thing that we call technical analysis. The charts, they're pictures of what others' beliefs are and their expectations that are created with money. That's what you're looking at. It's not about haramis and dark cloud covers and so on. It is about that picture tells me what others, however they approach the markets, technical analysis, fundamental analysis, planetary alignment, they're placing bets with their money, and those charts are forming pictures. And it says they're communicating to us how other traders have acted. What are their beliefs? What are their expectations in the time frame of the moment? So those candles provide us pictures of those expectations on an ongoing basis. So I use the word candle language. They're the basis for our continuous thoughts and trading decisions. Markets move, especially on an intraday basis. We need tools that allow us to update that information. In addition, we need tools that allow us to say there are certain candlesticks or candlestick bars arrangements that can be noise within a bigger picture. So you need to be able to discern that. Now, going back many, many years ago and reviewing all of my trades, hundreds of trades, and trying to learn what is the reason for some of them working and some of them not working. Well, there's this thing called the broader markets, and there's a concept called intermarket analysis, the relationships between stocks and bonds and commodities and currencies and how they interact with each other. The technical analysis part, which we all focus on here, reading those patterns and trends, support and resistance, we can come to those concepts from different points of view. How we read those indicators, no indicators, different choices of different indicators, and so on, and market internals. Now, from a day trading point of view, the 5-minute time frame, I'm not so interested in the swing trading type of intermarket relationships necessary, because there's from a longer term perspective and those market internals. But from an intraday trading perspective, I will want to know some of that and how to put that together, especially if I'm going to trade semiconductor stocks. It probably would make sense for me to know where support and resistance is on the ETF from a broader timing perspective of where that support, resistance, and trend is. And I can define from there which stocks within the sectors are showing relative strength and weakness, and putting this all together. Market internals, again, another part of the subject, but just to give you some insight, measuring extremes using an NYSE tick, or how many stocks are advancing versus declining, and what the trend is of those advancers minus decliners, can be extremely helpful. But as we look at this as a three-legged stool of coming together to put the odds in our favor, it's really priceless, because when the technical analysis part alone, trying to determine why did that trade work. So as I looked at all those trades many years ago, and I said, that setup looks exactly like that setup. Why didn't that one work? And why did this one work or not work? And so it came down to understanding these relationships of internals, intermarket analysis, what's the broader market doing, and how to time that from an intermediate and short-term point of view. Now, my whole goal over these years is simplification, because there's so much related to technical analysis that I'll refer to as just pure brain damage. You can go way out on the dark side with the Elliott waves, the fibs, planetary alignments, and all kinds of craziness. And then getting into indicators and different settings and so on. But with candlesticks, you can spend an inordinate amount of time learning candlestick names. So let's just simplify this. Right? There are big candles. There are candles with tails on them, bottoming tails, topping tails. Did sellers take control? Did it was the upper end rejected? Where did that happen? If prices went down to support, did it turn into a bottoming tail bar? And then there's combinations of these bars. Ultimately, where do they happen? So a big green bar in the middle of nowhere in a downtrend is not going to be as powerful as looking at a big green bar that has moved into an area of support and say a rising 50 MA in an uptrend. Can you see how this is common sense? But when we cloud our minds with the indicator-based mythology and all of these names that we can start applying to these candles, things can become very confusing. The analysis paralysis syndrome begins to set in. The goal is simplification, and with simplification comes clarity. That is our goal. So, do I use any type of an indicator? Well, I'm hesitant to call it an indicator, but it is what it is. I use a few moving averages that I refer to as visual aids. Well, what does that mean, visual aid? Well, it helps me speed up the analysis as I'm flipping through charts and I'm doing scanning and I'm looking for that picture that, to me, that picture means that is a representation of buying within an uptrend at support. In addition, as I look at those moving averages and I look at the distance between the two, what is the slope of those moving averages? Are they intertwined with each other, or are they both, well, three, depending on how many you want to put on there? We're going to limit that. Are they all sloping up? Are they sloping down? What's the distance between them? And ultimately, we're looking for price. But again, as a visual aid, when I turn that chart from, say, IBM to Apple or gold, right, that picture changes. And so in an instant, because I have that picture ingrained in my brain, it communicates to me many, many things in a microsecond of, yes, that's going up, that's going down. I'm not interested in that because it's going nowhere, or this is in an area where I need to pay attention to. Now, many will look at moving averages as being actual support and resistance. It's nonsense. I mean, just because you pick something to put on your chart doesn't make it support or resistance. Certain moving averages that are widely followed, like a 50, a 200, simple on equities, can become a self-fulfilling prophecy. So if I'm looking at the S&P 500 and it comes down to a rising 50 MA, I know institutions are going to be buying there, so I pay attention to it. It's a useful piece of information. So the moving averages that we use on a daily time frame, as I said, can become a self-fulfilling prophecy where others are focused on those, where they can create supply and demand. Now, I also want to look at them in multiple time frames, which we'll do. And so we don't trade those moving averages per se. They just become part of our toolbox. And by looking at it like that, I say, well, we're becoming a master trader because we're eliminating much of the noise that we can become a victim of. So what are the advantages of trading with a trend? Well, high probability of success, institutional conviction. I'm trading with the flow of what the majority are looking at. It puts the odds in my favor. The momentum, it works in my favor. Prices, they're likely to continue in that trend direction rather than, well, they could reverse suddenly. We've seen that happen, but the further prices get from a moving average, we know the greater the probability that prices will retrace. And it's not about being overbought. Prices can stay overbought for a very long time. Right? We just look at them at prices as being extended. The prices, the more they become extended, the greater the probability that they're going to pull back. It's that simple. Right? So easy management, clear opportunities for professionals that know what to look for, cleaner chart patterns. Why are the chart patterns cleaner? Well, we go back to charts are a representation of what other people think and their expectations. So the more trends that are moving in one direction, which we're going to look at, the greater the probability that you have more traders and institutions thinking the same thing. Buy, right? Buy breakouts in uptrends, buy pullbacks in uptrends, more individuals looking to do the same thing in unison. We work together, and looking at multiple time frames and moving averages moving in the same direction, we know the majority are working together. Right? Less emotional stress, right, than fighting the trend, and ride the wave, so to speak, capture larger moves and letting the market do the heavy lifting. So looking at these trends, you can see I've got a 60-minute chart, a 15-minute chart, and a 5-minute chart. Would you agree that they're moving in the same direction? Not a trick question. It's obvious. It's obvious what we see happening. They're moving together. And as we see that, I'd say, would you agree that the long side, these time frames are aligned? With that being said, at that point, right, if they're all moving in the same direction, our trading plan says buy at the appropriate time in the time frame that you're utilizing. So from an intraday trading point of view, I'm interested in the 5-minute time frame, but I'd like to have the 60-minute aligned and the 15-minute aligned moving together. I'm going to show you a really simple way to do that while looking at the 5-minute chart. So how do we do that? Well, how do we use those moving averages to see the trend and location of one moving average from one time frame to another? And this is how you do it. You calculate the number of bars in the lower time frame that make up the higher and multiply that by the moving average in the higher time frame. That's your moving average in the lower time frame. That'll equal the moving averages that you're looking at in the higher time frame. So professionals, master traders, they translate higher time frames into lower time frames to maintain alignment. So by looking at that one chart, I know what's happening in those other time frames. By eliminating looking at too much, it brings clarity to what I'm doing. I'm not looking at so many things that all of those layers will tend to add confusion. What thoughts are all those other time frames going to be bringing to you that now play into your mind versus thinking, hey, all these time frames are moving in the same direction. And within the 5-minute time frame, that has created a pattern that tells me that this is an opportunity to buy. That's what we're after, simplicity, and then looking at a pattern that tells me that buyers have taken control in this moment. Right? Again, back to these pictures being traders' beliefs and actions and expectations. Multiple time frames aligned mean multiple traders thinking the same thing, looking to get on board for the same trends, expectation that they're going to go higher. So as we look at these pictures, right, and someone's asking the description of the time frame, was it an error? No, it's not an error. Right? I'm going to get to the point, but we have to lay the foundation to get to the point. So I could just show you a chart and say, hey, look at this chart. It's a 5-minute pattern. That doesn't really help you to understand why you're doing something. So as we look at these trends through the eyes of moving averages, this is a thought. Right? It's one of the concepts. As they move closer together in trend agreement, volatility is contracting and should expand in the direction of the trend. So when the 5-minute is in alignment with the 15-minute, and I told you how to calculate the moving averages. So that 60 MA is equal to the 20 MA on the 15-minute chart. 20 MA is a widely followed moving average on whatever the time frame is. So the 60 being close to the 20 tells me that prices have consolidated, right? In likelihood, at the way these moving averages are aligned, getting tighter, there's been some sideways consolidation. And those looking at the 15-minute chart and those looking at the 5-minute chart are coming into agreement that they're looking to sell within the downtrend, right? The moving average is, we look at that moving average and it's pointing down, which means the trend is going down. And so the 60-minute trend, the 200 on the 200 MA on the 60-minute, as the 20 MA on the 60 is equal to the 200 on the 5. All of these, the shorter MAs are below the longer MAs. All of these time frames are pointing down, so the odds are in your favor that it's going to go down. It's simple. Now, this is not what we're looking for. This is ultimately, just call it a mess. A lot of overlapping bars. But through the visual aid of moving averages, I can quickly just see the moving averages are intertwined with prices. I'm not interested in this. There's too much indecision and uncertainty about what's going on here. Just move on. Don't try and make sense out of it. There's no reason. There's too many other things to look at that will put the odds in your favor. This is just a picture of this is not it. So just leave it. Now, a little bit about money management. This is the simple part, that chart on the right. If you're not share sizing accordingly to what your risk is, you don't have a chance. You don't have a chance in hell. You might get lucky, but you're not going to last, because preservation of capital has to be your ultimate goal, especially starting out. Because if you're starting out, you don't even have a plan yet. You don't know what you're doing. You're just focused on making money without, which is okay, but you don't know what you're doing. So you're dangerous to yourself. So professionals, right, have a structured plan. So our 5-minute plan, what's our daily bias? Is it going up, down, and sideways? Is it at support? Is it at resistance? What's it doing? Is there multiple time frame alignment? Is there intraday confirmation? Is there a trade setup? What is your risk management? So as you put those all together, you know what you're looking for. You have to have discipline and rules, a trading plan that allows you to make decisions, or should you just sit on the sidelines because things aren't set up for you? Now, what I'm going to show you here today is one way of looking for a trade setup on the 5-minute. It works. Your goal is to utilize what works. As you learn more about different setups, you can use different strategies. But this is what we're looking for, right? If I'm looking for longs, I'm looking for a daily chart. Is it going up? Is it above the moving averages? Has it pulled back to an area of support? So we start with the daily time frame. I look at the 60-minute time frame. Sorry. As I'm looking for that, I can see it's trending up. There's your 20 MA on the 60-minute. It's pointing up. As prices are closer to a moving average as they are here, well, there's going to be closer to an area where I'm going to want to get in, closer to price support. There's a 20 MA on the 15-minute chart, the lower left. And now on the 5-minute chart, I've got my 3 moving averages. The blue line is the 20. The pinkish line is the 60, equal to the 20 on the 15. And the red moving average is roughly equal to the 20 on the 60. In addition, I've added a blue horizontal line, which is today's open, and a red dashed line, which is yesterday's close. Those become focal points for intraday traders. In addition, if today's open is above yesterday's close, that means the daily candle is green. Well, that in of itself is useful information because it tells me that most are probably still thinking long. And if I've got multiple time frames in alignment on the 5-minute chart, getting setups where I've got this green little half moon there, where it's coming down to test some support and it flips back up, you can see that black candle, and it reverses right back up with the blue candle. It's just marking wide range bars. I have a bias that things are going to go up. Why? Multiple time frame alignment. From there, I'm looking at my 5-minute chart with a price pattern that tells me buyers are taking control. In the moment, in any given moment, sellers could be in control or things are going down for whatever reason. But ultimately, I'm only looking for pictures that support my bias. Multiple time frames are going up. That's it. Once I have a picture of that, next step is, what's my entry point? Where's my stop? What's my share sizing to get on board? Another example, daily chart. You can see it's kind of a rounding kind of a top, call it a head and shoulders top. It's a distribution pattern. It starts breaking down. Well, as it starts breaking down, right, many times after 2 o'clock, like right around now or a little bit before, most of the times around 2:15 or so, things tend to start moving again. So after 2 o'clock is a time to pay attention. And many times it happens is exactly 2:15. I don't know why, but it does. But we're looking at our 5-minute chart in the same way. What am I looking for? I'm looking for trend alignment. I'm looking for at 2:15, the 60 and the 20 to come closer together, tight, because now I've got those two time frames coming into alignment. All three moving averages are pointing down. And based on the daily chart, there's room for it to fall. So I have now created a belief that prices are going to go down. The odds are overwhelming that they're going to go down based on this analysis. How fast will they go down? I don't know. It could fall just like this chart shows. It could start to trend down. I don't know how it's going to go down, but my belief is it's got a very high probability of going down based on what I've explained. Another example, daily chart trending up. 20 is above the 50. So on the daily time frame, I'm using the 50. Why? Because that's what most are looking at on a daily time frame. I'm only looking at the 60 on the 5-minute because I want it to relate to what's happening on my 15-minute chart. Simplicity. So the daily trend is going up. What was happening, it was preceded by some sideways consolidation. You can see in that daily time frame that you see that long bottoming tail bar. That communicates to me that institutions are lurking below, and they drove it all the way back up into that consolidation within an uptrend. It was a big red candle. So institutions are looking to buy this thing, whatever it is. It doesn't matter. We look at the chart in the same way. Now, I could look at what sector it's in, and it's another conversation, but look, it's going up. 5-minute chart. The 20 MA is pointing up. The 60 MA is pointing up. The 60 is pointing up. The 60 pointing up. The red one is the 200. It's above yesterday's close. It's above today's open. Buy pullbacks. That green arrow up there is pointing in the beginning of the chart there, just above 12 o'clock. Right? You have that buy setup just before it. And then it gets retested. Right? The bottoming tail bar after the green arrow pointing up. Again, that communicates to me that traders are looking to buy below their bidding. And then the ones that don't get filled on the bid, they take the offer and they drive it back up again. And so as it goes up, the second green arrow over to the right there, you got another bottoming tail bar at the rising 20 MA. It's another buy setup. From there, it should keep going up. And wash, repeat. And that happens at around 2:15, a little after 2 o'clock. I said at 2 o'clock, it's time to pay attention. Just more examples. Once you have the plan, it's wash, repeat. That isn't to say that every single day things are going to set up just perfectly like this. But if you can find the discipline and patience to wait for that, the odds are in your favor. And that is the ultimate goal. Now, this daily chart, another one of those half moon type circles, arches that are there. Look at the big red bar in the middle of that. Didn't you think when seeing that prices would go down? I mean, it's a big bearish bar. Call it an engulfing, call it what you want. It's just a big, nasty red bar. Well, 5 bars later, it's not going down. So big, nasty red bars in the moment tell you that sellers took control. But 5 bars later, it's not going down. And the bar preceding the big green one was a bottoming tail bar. Buyers are lurking below. Bar by bar analysis, candlestick language. It's communicating to you that there's demand, strong demand. Okay, I'm a day trader. 5-minute chart. Find me a picture. There it is on the right side. Prices pop up. Same type of a rounding kind of a bottom there. And it breaks out right from where the 20 MA is. Moving averages are in alignment. And based on the daily chart, this has plenty of room to go up. In addition, that big red candle and going sideways must have created a belief, as we said, it would go down, which is going to bring in people that are going to want to short. I'm not saying they're wrong. I mean, it's at a rising 50 MA. Maybe they want to think about that a little bit. In any event, if the chart is producing beliefs to some that something is going to go down, they're going to act on it. And that will bring in additional demand when it reverses, short covering. Another example, wash, repeat. Prices are in a downtrend. Look at the alignment of the moving averages. Is the 20 under the 60? Is it flat? Is it pointing down? Is it under yesterday's close and today's open? Is the 60-minute trend pointing down? Now, as it's gone down and it's under today's open and yesterday's close, you see that those are relatively close together where they're marked. It attempts to go up and it can't. Just after 1 o'clock, there was a relatively large green candle. Buyers tried to take control and it didn't work out. If you apply this bar by bar analysis concept in alignment with multiple time frame alignment, odds are it's going to go down. Now, there are bars on there where it tried to go up and there's little tails on the top. And after 2 o'clock, it couldn't go up. It's likely it's going to go down. So sell the breakdown. Wash, repeat. Another example. So 5-minute chart. Before you looked at the 5-minute chart, you would look at the daily. You'd get your bias. What's the trend? Where's support? Where's resistance? The word void is to communicate a lack of support or resistance. So as you look at the chart, the daily chart, example, this one, right, that daily chart, because of the way it came down and the sideways consolidation, it's got ample room to go up before it reaches any resistance, which is up above. This helps me to create my bias or belief that something can go up. Now, as I'm on my 5-minute chart, are the moving averages stacked bullishly, 20 above the 15-minute trend, the 15 above the 60-minute trend? Are they pointing in the same direction? Yes. Buy pullbacks, buy breakouts. Wash, repeat. Can we use gaps for this? Absolutely. That guy on the right, let's call him hedge fund manager George. And he's like, hey, this was in an uptrend. It moved up, it consolidated, it broke out. I'm a buyer. And it's like, holy crap. The next day, what the hell happened? It gaps down under the breakout bar. Shock. Well, at that point, if hedge fund manager George is thinking long and many others are thinking the same thing and it gaps down under that consolidation, there's an increased probability that they're going to sell. Right? We're looking at what other traders are doing. The chart gives us a belief about what they're doing. And if that belief is immediately reversed, odds are they're going to unwind those positions, which increases supply, which can drive prices down. And that is the idea with gaps. And so while we can use gaps for either longs or shorts, the most powerful thing they could do is, one of the most powerful things they could do is immediately shock traders that are in that, because we know based on where stops are going to be and what they were thinking before, right, we have a pretty good idea what they're going to do next. So another example, right? Traders are thinking higher on the green bar, the daily green bar. It's in an uptrend. It closed near the high. Probably there were buyers into the close. If I look at the 5-minute chart on the right, prior to the gap down, right, they was buying right into the close. Right? Remember, the red line is the prior day's close. And so it gaps down under the low of the wider range green bar on the daily time frame. It's not good if you're long. So apply the basics. Support becomes resistance, the green circle on the 5-minute chart. That's where there was support the prior day. Prices pulled back and it started to go up, and you see the moving averages were pointing up. It gaps down. Right? The first 5-minute bar is a giant topping tail bar. So it was a big green bar. It came up into that prior area, the blue line that I put there, and it got driven all the way back down again. Sell it short under the low, put a stop, an ample level above that topping tail bar's high. Manage. How do we find these? Well, I've created scans using TC2000, if you use it or not. If you become a member of Master Trader, we share these with you. But every day, you're going to easily find what's gapping up, what's gapping down. Down below, is it gapping above the high of a green bar? Is it gapping above the high of a red bar, I should say, or gapping below the low of a green bar? What the chart that I showed you. If it is, you know what to do. Right? Support, resistance, 5-minute chart. Which way is it trending? I've got thousands of these accolades from students. Remember, I've been teaching this since 1994. And not exactly all the same markets change, but right, we're doing it right. Simplicity and teaching people the right way to trade with simple methods. You can check us out on YouTube or Facebook or X. Every day we're there 9 o'clock doing pre-market. On Wednesdays, we're doing reviews. But check us out on YouTube /Master Trader on YouTube. We're there every morning at 9 o'clock, pre-market, open trades, internals, and so on. What do I offer you today? Great education. Of course, how the market works. Even if you're new, believe me, this is going to put you head and shoulders above the rest. A top-down approach, how the market works, understanding technical analysis, basics of options, the gap course. I teach you 7-point strategies for trading gaps intraday. Lots of examples of the 2-minute time frame trader. Money management, position and money management, which is so important. This gets so deep into money management. Yeah, you're going to have to do a little math, but you're going to learn how to add to positions properly. And a month in the green room with us, doing it real time, day in, day out. The education is priceless. And then lifetime monthly coaching strategies. And if you use TC2000, I'll share all of my layouts with you for free. So today, under $1,000. The education is tremendous. I mean, there's probably, I'm telling you, there must be 30 hours of education in these courses. But consider it. You've got the link, which will be shared with you. You're welcome to email me, Greg at MasterTrader, but mastertrader.com, precision trading, and you could get signed up. You can be in the green room with us tomorrow morning. Right? So, has any questions, like I said, email me, Greg at MasterTrader. And I think I got 3 minutes left. If you guys have questions, I didn't want to run over my time and step on the next speaker coming. But
Hey, Greg, you're actually 1 minute over right now.
oh, okay.
But
So there you go. I did okay with that. So as always, guys, consider joining us at MasterTrader, and we'd love to see you in the green room tomorrow morning. All the best.